My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. My friends, I'm just trying to make you a little money. My job is not just entertainment, it's to teach you, to educate you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. There's something happening here, and what it is exactly clear. We've become a nation of cheapskates. I say that as a compliment. Nobody gets away with charging too much anymore, not in this country, no matter what industry, perhaps even the drug industry. It's happening now. It's happening fast, and many companies are being left behind by the change. I see it everywhere I go, in the grocery store, online, in the mall, and, of course, in the stock market, where you either demonstrate value like a Walmart, a Costco, or an Amazon, or you get slaughtered like a Target, which plunged $33 or over 21% today. And that's my takeaway from this sedate session, with the Dow gaining 139 points, S&P flat on the day, and NASDAQ dipping 0.11%, although it was much uglier midday. We think this cheapskate story is limited to retail, don't we? But it's not. For example, I've never really thought about value when it comes to tech. I cared about whether there was a better mousetrap. The price of goods was constrained by one simple issue: how much the customer is willing to pay. And the customers seemed pretty blind at cost when it came to tech. But now with Nvidia, the largest company in the world, by the way, we're seeing something wholly different. We're seeing a company with a product that's incredibly expensive on the one hand, but incredibly cheap on the other. If you're a cloud service provider and you give Nvidia 40 G's for a version of its latest and greatest chip, a Blackwell, you can make 5 times that. Insanely expensive as a product, dirt cheap as an investment. We keep hearing that Nvidia is charging too much, or that demand is topping out, or the stock's overvalued, but the proof is in the pudding. And CEO Jensen Huang has repeatedly told me about this 5-to-1 ratio, profit to cost ratio. That's not just talk. This quarter backed it up. Nvidia reported a sizable top and bottom line beat. Healthy guidance for the current quarter. Blackwell, that latest invention, full production, which was a huge worry going into earnings. Maybe that worry was contrived, ginned up, perhaps. Jensen says demand for the current chips and anticipation for the new ones is, quote, incredible. Of course, there's sellers, grumpy, clueless people who keep hoping for another one-day gain of 20% like we had last year on earnings, and they are disappointed. I say let them sell. I don't care. Here's your hat. What's your hurry? And don't let the door hit you on the way out. The cloud service providers, Amazon, Google, Oracle, Microsoft, simply can't resist buying these high-end chips. Not because they feel compelled to keep up with the competition. That was another bear canard. But because 40 G's for one of these is a bargain. I'm sick of the bears telling me there aren't enough uses or that things are maxed out at Nvidia. I say do some darn homework. The so-called expensive Blackwell is about making money with your money. Nvidia is about value. You see the kind of bargain hunting I'm talking about everywhere these days, even in pharma. Go listen to that Walmart quarterly conference call. The only fly in the ointment the whole time was the price of the GLP-1 weight loss drugs and how they ding the pharmacy business's gross margins. How could the price of one class of drugs be so important? I think it's because there's a scarcity of GLP-1s, even with Eli Lilly and Novo Nordisk going all out. It's only going to get better, though, because Lilly's spending billions to build more plants in order to meet the demand for the wonder drug. No one else can do that. They aren't rich enough. The GLP-1s, they represent value. Because it's not just about diabetes and weight loss. They're lifesavers. They're being used against hypertension, being used to reduce major cardiovascular events. They can help control sleep apnea. And, of course, they're also effective, never mentioned, never talked about, against alcoholism with its terrible liver side effects. Millions of people, they haven't gotten approved for any of these indications. They'll never get it for alcohol. Too complicated. But GLP-1's not some simple hack drug. It's a revolution in healthcare. No wonder Eli Lilly can charge such a value, such a huge premium. It's valuable. What else? We have all sorts of data about how going out to dinner costs a lot more than it did pre-COVID, but people hate that. You know what? They really like companies that are trying to do something about it. Hence why Texas Roadhouse and Brinker, home of Chili's, are just crushing the numbers and making mincemeat of their competitors. I went to a Texas Roadhouse recently in Dallas. Oh, man, I spotted a dinner for less than $11. Made me feel like a king. Country fried chicken or grilled barbecue chicken or pulled pork or chicken Caesar, 2 sides, $10.99. Are you kidding me? In 2024, not possible, but it is. That's only bested by the 3 for Me deal from Chili's that you see advertised during every single NFL game. Fountain drinks, iced tea, chips, salsa, and that killer smash burger. for $10.99? Again, you must be kidding me. In 2024, yes. There's one word reason why Brinker and Texas Roadhouse are up 189% and 58% for the year, respectively, and that's value. The American people are tired of paying up. They feel gouged. They feel betrayed. They feel that the only thing about brand loyalty is that it isn't worth a dime. They want a better deal. They'll eagerly switch lifetime habits in order to save some money because prices are up so much that you feel like an idiot if you're paying up. And there's a reason why Costco has tens of millions of members. I wish you could go with me on a field trip to Costco. It's just wild. I went to the Costco near Allentown, Pennsylvania the other day. It was more of a pilgrimage. No pilgrimage complete without a stop at the food court. In 1984, Costco offered a quarter-pound all-beef hot dog and a soda with free refills for $1.50 in a Portland, Oregon store, and it's nationwide now, and it's the same price. Are you kidding me? Whenever we stock up at Costco, I pay a king's ransom because we're loyal to the cause of low prices, and Costco has instilled that loyalty in a very visible way. I like to go to Costco on an empty stomach because, man, those free samples are dynamite. You see the little small pizza squares lately? Whew. Don't fill up before you go there. But it's the $1.50 dog that makes me yearn for Costco. They can offer great deals because they carry a smaller selection of products. Enormous bulk gives them a lot of leverage. Yet right now, people only have loyalty to value. And that's the kind of country we've become. The value of a belt, thank you, or a shirt or underwear or jeans from TJX. Shot the lights out this very morning. They buy excess inventory for struggling retailers for next to nothing, then mark up the goods ever so slightly, giving you amazing bargains. TJX has been keeps building a lot of stores because they can't keep up with demand. Look at this thing. I got this thing for $15. Hey, the other guys are a pound of flesh from Venice. This is from Milan. $15. I would take it off, but I think it's probably not the right. I don't know. We got new people coming in running the company. I don't want to leave a bad impression on them folks. Anyway, TJ Maxx, I love it. Which brings me full circle to Target. Our loyalty to value means that if you want to buy Dixie paper bowls, Kellogg's Fruit Loops, Dawn dish soap, and Tide Pods, and then have them delivered, we'd much rather pay $48.13 from Walmart than $62.96 at Target. Yes, those are actual prices, actual goods that were bought today. And that's too big a differential. Walmart, Scale, and Smarts are simply besting Target in the price arena. Don't get me wrong, I love Target. I think it's so much fun to shop there. But in this new sit at home and order world, why do I really care how much fun Target is? If they can bring it to my house at roughly the same time, why do I care if it comes in a red and white bag or not? I am loyal to value, and Walmart is offering me value.
House of pleasure.
And that's why Walmart stock could be up 66% for the year and still climbing, while Target's off 14%, most likely still falling. Bottom line, prices have gotten so high over the past few years that we're losing our loyalty to brands. These days, this whole country is about one thing: the Benjamins. I said we take questions. I said we start with Chuck in Florida. Chuck.
Hey, Jim. It's Chuck from Boynton Beach. How are you?
I'm Boynton Beach, and my wife will be there in about a month and a half, and maybe she'll have me. I don't know. She's not that crazy with me lately. Maybe it has to do with the NFL and watching too much football. What's going on?
Yeah, I just wanted to say it was a pleasure meeting you and your wife in Palm Beach a couple of months ago. I'm still sipping on.
Oh, you went did you go to the bottle signing?
Sure, yeah.
Man, that Phosphoro, I love it. We got the new version Ensemble. What's going on?
Yeah, Jim, I want to ask you about a digital bank in Latin America. They do their business mainly in Brazil, but they branched out to Colombia and Mexico as well. They had a great third quarter. They're rapidly growing, and they're going to launch a telecom mobile service as well. Warren Buffett has taken a stake in them. And, Jim, I wanted to get your opinion on New Holdings, symbol NU.
You know, I've been waiting for this thing to explode because it's got some of the best shareholders, some of the smartest people in the world. I've been waiting, and now it's happening. And you, my friend, have horse sense. I like that stock. Oh, come on. I want more questions. I got the music. I'm trying to make a new impression over here. It's control room people. It's actually not control room. These are the people I'm up against. I want to do more. They want to do less. Okay? Oh, that fellow's from London, I think. All right. Look, the consumers' loyalties have changed. Allegiances to specific brands are out. and loyalty to value is in. Oh, man, tonight, Williams-Sonoma soared to new all-time high today. I'm checking in with the CEO, fresh off that retailer's raised outlook and earnings beat. Then Palo Alto Networks crossed the tape after the close. Yeah, the sellers come in because they don't know what they're doing, but that's okay because you have every right under the first minute to be as stupid as you want to be. Plus, I'm sitting down with Stanley Black and Decker CEO to hear from how Trump's trade policy could affect their business. So stay with Cramer. Well, you look at this incredible breakout, one of my favorite stocks, Williams-Sonoma, the furniture and home goods retailer that also owns West Elm, Pottery Barn, some other brands. At a time when retail space has been truly troubled, Williams-Sonoma turned in a magnificent quarter this morning, one that sent the stock up a staggering 27% today. Truly amazing. Not only did they deliver a big top and bottom line beat, they also posted better than expected same-store sales, raised their full-year forecast potentially, and they got a ton of cash. They're buying back stock. Were they ever right? Of course, even that doesn't explain this monster move. In the end, a lot of money managers were also betting against Williams-Sonoma, shorting the stock in anticipation of some sort of big miss. Those shorts got squeezed today. They were forced to buy shares to close out their position. That sent the stock even higher, new all-time high. Let me just tell you something. They are useful idiots, helping to get shareholders higher prices. Thank you. So how the heck did Williams-Sonoma pull this off at a time when so many of his peers are struggling? Why don't we go straight to the source? Let's go to Laura Albert, the president and CEO of Williams-Sonoma, to find out. Ms. Albert, welcome back to Mad Money, and congratulations on a staggeringly phenomenal quarter.
Thanks, Jim.
So let's go over what you did here, because it's not just you're a nuts and bolts person. You talk about great supply chain. You also you gain market share. But in reality, I want to step back for a second. There's a line that caught me in the conference call. We are a lot more than just a furniture brand. And that is the truth about what you're doing here, isn't it?
Yeah, I mean, it's not just a macroeconomic play associated with housing, right? We have lifestyle brands. And we have life stage brands, and we have our furniture business. And the truth is, we still ran negative comps in Q3. And yet we're delivering exceptional operating earnings because we're focused on our customer service. And that customer service has always been world-class. And by focusing on it, we build up that loyalty with our customers. And they trust us. They shop online because they know how good the quality of the product is because they've seen it in their stores. And also, we have approachable prices. There's a lot of people selling things that are beautiful, but our prices are approachable. We have great value in the products that we sell. And so at this time of year, which is our favorite, by the way, this is the time people come to us to decorate their homes, celebrate the holidays, and buy gifts. And we are stocked and we are ready for the holidays. Well,
you are holiday headquarters, and I want you to tell people some of the exciting things they got. I remember for Halloween one time, I got stuff that was just incredible from you. How about for Christmas?
Well, first, let's talk about Thanksgiving. I don't know if you're set for Thanksgiving. I personally set up both my Thanksgiving table and all my Christmas decor last weekend. And my favorite product this year is this, which is our Thanksgiving Crunch. It's like your chili crunch, but it tastes like the Thanksgiving dinner. So if you have people coming over who don't want to eat the turkey or you want to make a different meal, this is instant Thanksgiving in a jar. We love this. So that's a new product. But of course, the favorite, and I'm just talking about the Williams-Sonoma brand, but you know the favorite. This is the favorite. And this is the time of year that this comes back out. And I was just in our stores near your house, Jim, in New Jersey, and I talked to a woman who was buying 30 of these, giving them to everyone. And I was so inspired. I mean, people are so excited this year. When you go out and you go to these malls, you'll see how happy the shoppers are and how excited they are about the holidays. And so different from the pandemic. I mean, we're back at retail. It's very exciting.
Well, I do want to go back to something you said about customer service. It is very clear that you are taking market share, part of it with customer service, but also part of it because you're offering a super premium product at what many people think is a value price. How are you able to explain that to people? Because no one else is doing that. No one.
Well, we've been at it for a long time, and we've had these vendor partners for decades. I know their children. We have been doing business. We've built our businesses together. And we work together to bring great products to life, but also to reduce costs and constantly look at ways to make the product better. And it's direct source, right? So we're directly sourcing. We have our teams in Asia doing that work and going and making sure the quality is perfect. And sometimes we have a few issues here and there, and we do our best to make it right for our customers. But our perspective is when we price the goods the first time, we want you to say, wow, it's a great price and how gorgeous is that product. And that's the focus we've had since the pandemic, is to continue to pull back on this up-down promotional pricing that so many of our competitors run. And they're running buy more, save more. If you spend this, you get this much off. And that's all good for the short term, but then you get customers trained to wait for that promotion, which is never a good thing because you're really competing with yourself. But it's harder to actually pull this off than you think, because in the short term, you see the negative numbers. So I've been singing this song for the last 2 years, and I'm pulling it back, and now you're starting to see the real effects of that reg price business and the customers trusting us on the pricing integrity the first time.
I think everyone else is caught in that spiral except for you, and congratulations to you for not being caught in that miasma. I mean, it really is amazing how prevalent it is, and it never works. They think it does, but it doesn't. Now, you're doing something. We see a lot of collaborations. I think there's too many people just talking about collaborations like someone did something on Instagram. You've got big-time collaborators, and you're saying it's driving brand heat and bringing new customers, and they're two of our favorite people, so go ahead. The two most famous ones, the Tucci and Jean-Georges, are just, I can't wait to buy them.
First of all, the nicest people. So gracious. They come to our store, they sign books, they talk to our customers, they love what they do. And when someone loves what they do, it's really infectious. And, Stanley Tucci is just amazing. He has a new color out that we love. He has new products coming all the time. And then Ina Garten is our Thanksgiving partner. But beyond just the Williams-Sonoma brand, which we talk about the most and has the biggest spike at, the Christmas holiday season, the other brands too have amazing partnerships, especially our children's home furnishings business. We have had this incredible partnership with Love Shack Fancy. They do such a beautiful job with their proprietary look, and we have developed a whole bedding and bedroom collection around it. And we keep adding to it, and it's great for dorm rooms. It's great. Anyway, so we love that. And then we do fun things. We don't take ourselves that seriously. We're doing National Lampoon, at Pottery Barn. And in all these brands, we have a variety of real tastemakers, and then also, people who are just in the zeitgeist of being popular and fun. And that's what we do. And it brings new customers in, and it gives our current customers something new to buy.
At the same time, you are more competitive than ever. I was talking, you're on the board of Salesforce, talking about with Mark Betty up today. You're just not stoppable. And I brought up the fact that you talk about these wins. You won the JW Marriott in Vegas, the Ritz-Carlton, the Papagayo, the Google, Sony. These are big wins for you, correct? I mean, you do so many things, but this you beat other great competitors to get.
The B2B is a real growth driver for us. I think it's been underestimated. And we haven't even begun to scratch the surface on the potential there. A lot of people don't even know we're doing it, right? And so we continue to build the infrastructure. We have an incredible team of people selling products to all the people you just mentioned and more. And what we can do is we can design the whole thing for you. We don't just have one line. We can do the whole thing. And if you need something very special, we can work on that together. So it's a big deal. It's a big part of our growth story.
Well, look, I want to congratulate you and all your shareholders for just really doing a remarkable job in one of the toughest environments I've seen in a very, very long time. Surprisingly tough, given where unemployment is. Just great job, Delora Albert, President and CEO of Williams-Sonoma. Fabulous that you came on the show. Thank you so much.
Thanks, Jim.
And Money's back after the break. What should we make of these results from Palo Alto Networks, the cybersecurity powerhouse? It's been a huge winner for my charitable trust. After the close, Palo Alto reported what I thought was an excellent quarter, an 8-cent earnings beat off a $1.48 basis, higher than expected sales, up 14% year over year. All the key enterprise software metrics like remaining performance obligation, next generation security, annualized recurring revenue, they were great too. On top of that, management gave us strong guidance for the current quarter and raised its full year forecast for 2025. Now, look, this stock has a habit of selling off in response to earnings. That's why we pick it up every single time. I always tell our club members it's the time to go. I say don't sweat it. The stock was up almost 15% since the company last reported in August. I think some investors want an even more bullish forecast. I say give me a break. This is the way it is. So let's take a closer look with Nikesh Arora, the chairman and CEO of Palo Alto Networks, to learn more about it and, of course, know more about its 2-for-1 split. Mr. Arora, welcome back to Mad Money.
Thank you very much, Jim.
Nikesh, it looks like the quarter and the year off to a strong start. Maybe you can fill us in on where the big orders are coming from.
Well, Jim, we're seeing, I said in our prepared remarks and earnings call, this idea we sort of talked about in the last 12 months about platformization is finally taking center stage. We looked at how many of our peers are talking about platforms, and now we see a 50% increase in our entire industry of everybody saying, I've got a platform too. But no, we know that we are the premium platform as it relates to network security, as it relates to cloud security, and as it relates to the new area of SIM and SOC management with AI. So we're seeing tremendous amounts of interest in people platformizing. We had 2 videos we showed, one from Colgate, one from NXP, where the customers used to be customers of our products in one category. They have gone soup to nuts, Palo Alto Networks across the board because it gets them better security, saves them money, and they have to do less work. So we are seeing that trend take off. We did 70 platformization deals this quarter, including some of our QRadar deals. So yeah, we're seeing generally strong demand across the board.
Well, you're seeing great momentum in the platformization. I think that you're also seeing, amazingly, I didn't count on this, a kind of a renaissance of firewall business. I mean, it just seems like there's a refresh going on that's falling into your lap.
Well, Jim, I said this to one of the analysts who asked the question. I said, we're delighted that some of our industry peers have refresh cycles because that allows our customers to say, finally, I can consolidate on a single platform with Palo Alto where I already have their SaaS heap. So I'm really excited about their refreshes. We have a refresh every year because stuff that we sold 6 years ago comes towards end of life and we got to get them new firewalls. But I'm delighted that people are running out of old firewalls, want new firewalls. And I've always maintained firewalls grow 4 to 6%, 5 to 8% in the market. We've constantly, steadily shown that. We've constantly taken market share. It's kind of like, every year our market share goes up 2 to 300 basis points in hardware, and it's sticky. We don't have churn. The only people who leave are the ones who go to the cloud. And I keep reading now that people want to set up hybrid strategies because cloud is getting expensive. So I think we're in a good space. We like where we are from a hardware perspective. We don't try and set the bar too high from an expectations perspective, but we think we're going to steadily execute against that 5 to 8% number.
Well, that's what we want. Now, we talked last time, we had just gotten the IBM deal. I figure at this point you can start giving us a little feel for how that's working.
Jim, I was mentioning one of my board members and I had this debate yesterday in our board meeting about which deal is going to be better for Palo Alto, IBM or our Prisma Access browser deal. My bet's on the IBM deal. He bet on the Prisma Access browser deal. I'm delighted they both do well because we both win. So the IBM deal has been amazing for us. We got 550 customers this quarter from IBM and QRoC. We closed $80 million of TCV business with them. We've generated $1 billion pipeline together between IBM and us. We never had $1 billion pipeline between us and IBM ever in the history of our cybersecurity business. So this is good. This portends good business for us in the future. Of course, we have to go and do a lot of hard work, grind it out, win a lot of deals, but it's a forced event where people have to migrate towards the best SOC platform there is in the industry.
I'm glad you said that. I mean, sometimes we see these deals, they're for show, and I'll ask about people say, oh, yeah, that's a fine deal. This was clearly not for show. This is a very substantive, rigorous deal that you have with them.
Well, Jim, when you get a call from the really smart investors in the market, the private equity guys saying, oh, I didn't know this deal was in play. We would have loved to participate and say, oh, you must have done a good deal because those guys are very smart. And if they come looking and saying, why didn't we know about this? You feel like you've got a great deal. And it's great for both us and IBM. It's doing amazing for us and it's doing amazing for them.
Okay, talk to me. I use you as my Sherpa to understand a lot of things. You always explain, and particularly when we're in San Francisco, the CNAP market and why this is so important. Explain this to me.
Jim, what's interesting is the cloud security market. As everybody went to the cloud, we were all deploying to the cloud, we made mistakes. Somebody's configured AWS wrong or GCP wrong, and it's not the AWS's fault, GCP, it's the user's responsibility. You wrote some code, and there's a whole class of security capability in cloud that has emerged called CNAP, right? We have Prisma Cloud in there. But as we see the cloud workloads going to production, as we see people deploying AI, you're seeing that the security needs to be deployed in production. That's where cloud detection and response starts to play a part. Our business there has gone 10x in the number of agents we've sold in the last year, right? Because we're seeing people saying, protect me in production and take the noise that I'm getting in the configuration space and prioritize it. So I only focus on fixing the most important things first so I can't be breached. So I think this market converges in the next 3 to 5 years. Cloud security goes through a sort of next cycle where cloud detection and response and SOC become equally important. That, again, points towards our XSIAM product, which we are so successfully selling over the last 2 years.
Got it. Now, let's talk about government business. First, we have a change in administration. I don't know if that makes things so that it would be more interesting, more hot, because obviously the enemies don't really care. They just want to beat us. But also, the Department of Defense, big contract in play. How are you doing with them?
Look, the U.S. government has a lot of legacy infrastructure that needs to be replaced or upgraded. You're seeing a lot of technology focus already in the new administration. A lot of people who are talking about how this thing needs to move faster, things need to get more optimized. The only way to make things faster and more optimized is to deploy better technology, right? The benefit of AI is only going to come if you deploy AI. That requires data centers. That requires new technology. So I think we're going to see increased technology investment from things that the new administration is going to do. And I said this in our earnings call, we see a lot of high standard deviation decisions most likely, which hopefully will be good for us. But high standard deviation is high risk. High risk means you can have high return. So I'm positive. I'm hopeful that some of the changes that we're going to see are going to accelerate the investment in technology. To drive efficiency, you have to automate. To drive efficiency, you have to deploy AI. To do that, you have to do it securely. And that's where we all come in.
And then one last question. I am very happy my trust is very happy. You give us a 2-for-1 split. More people should recognize you're a science and math guy. You know that, even though it doesn't create more value, it does make it easier for people to buy a share.
We want to make sure that everybody in your club can go participate in our stock, Jim. So this is for you.
Well, they're certainly doing that. And that's why I'm so glad to have you on, and especially on an excellent quarter day. Nikesh Arora, Chairman and CEO of Palo Alto Networks. Nikesh, of course, it's great to have you on the show.
Thank you very much, Jim. Thank you for your
Mad Money's back after the break. Today, Stanley Black and Decker, the iconic power tool maker, held an investor event here at the New York Stock Exchange, where they laid out some exciting long-term targets for the business. Okay, it's been a difficult stock to own, I know, over the past couple of months, something we know because we own it for the Chapel Trust. Stanley Black and Decker roared into the Fed's first rate cut because historically when the Fed cuts short rates, long rates come down, mortgages get cheaper, people spend more on anything housing related. But this time the bond market didn't play ball, and long rates are actually up from when the Fed first moved. Plus, when Stanley Black and Decker reported its most recent quarter, management did talk about headwinds, understood, persisting into 2025, and of course we're worried about the impact of potential trade war and tariffs. So in less than 2 months, the stock went from 110 to 85 and change. I still think it works over the long term, as I wouldn't own the stock. But let's check in with Don Allen. He's the president and CEO of Stanley Black & Decker. Get a better sense of where the company's headed. Mr. Allen, welcome back to Mad Money.
Great to be here, Jim.
All right, so Don, you had a big meeting, and you talked about a lot of very exciting long-term goals. And I think it's pretty across the board that you want to make things, let's say, bigger and better. So why don't you give us a sense of some of the things you talked about? Because over the long term, I think things are going to go very well here.
Yeah, so we spent about 3 hours with our key investors and a variety of other analysts that were either in person or on virtually. And we focused on really making sure that folks understood how we were going to finish the supply chain transformation, but more importantly, what we were going to do to drive more value at Stanley Black & Decker and get our EBITDA initially up to $2.5 billion by 2027. And then we see opportunity to go beyond that after 2027. And it's really going to be driven by, we think will be, probably a modest growth story in the short term, but over time, gaining more market share in DeWalt, gaining market share in Stanley branded products and Craftsman, and then driving more opportunities in the supply chain around product platforming, better strategic sourcing, et cetera, et cetera. So we were really excited about telling that story today that allowed us to really get people to focus on a longer period of time versus just the next 12 months.
Okay, well, let's talk about the brands. I really want to focus on tools and outdoor for a moment. You know, it's DeWalt, Craftsman, Stanley, Black and Decker, Cub Cadet, which I know personally. These are unbelievable brands. And a lot of times we think, and I know I am definitely of this opinion, these brands are bigger than the company's stock price, so to speak. You know, they're remarkable brands that everybody knows. And could you explain to people, like, how important they are? I mean, on the Lowe's call, they talked about DeWalt being one of their biggest products. And did somehow things get lost in translation? We start talking about tariffs. We talk about rates. We don't talk about the brands, which are the best in the industry. How do we jive the two, so to speak?
The portfolio of brands that we've created, Jim, is the best in the industry. So we start with our DeWalt brand, which is the pro brand for the construction industry. It is the best professional construction brand out there today. And then we have the Stanley brand, which is for trades and professional construction and occasionally the do-it-yourselfer, which is more oriented around hand tools versus DeWalt's more power tool oriented. And then Craftsman is kind of the do-it-yourself enthusiast, the person that works in their garage, works around their lawn. And these three brands fit incredibly well together in a strategy. And there's nobody in our industry that has the power of these three brands. And when you look at these other brands here, like Lennox, Irwin, Black & Decker, and Cub Cadet, they're what we call specialty brands that allow us to be targeted in certain niches, certain markets. They're not as broad as the three big brands, but they're very unique and they're very specialized and they differentiate themselves as well.
It is hard to outrun the story of how rates didn't come down, housing, it's the worst housing market for turnover in 30 years. And we also don't understand exactly what is going to happen with tariffs. You can't necessarily go blow things out if those things aren't working in your favor.
That's exactly right. And I think we all agree that long term, this is a great industry.
Yes.
Interest rates will eventually come down to a level where mortgages are closer to 5%, which I think is an important hurdle for us to get to, which will free up more repair and remodel. It'll free up more home sales, new home construction and housing starts. That will really allow this industry to get back in a much stronger place than it has been.
All right, now let's talk about one that's strong and one that's not. You've got some incredible things going in fasteners, in aero, but you also have auto.
Yeah.
And auto's slow. You can't give away. I mean, at one point I just said, why doesn't Don just get rid of the auto? But you don't want to sell that at a trough.
No.
And aero is just terrific, but I kind of feel like the great nature of it gets lost in the shuffle of the brands. I don't know.
Yeah, the auto fastener business is very much a V business. So when it goes down hard.
Right.
When it recovers, which actually, interesting enough, I think what's going to make this business recover is lower interest rates, because it's affecting car purchases as well. So as that changes, then I think you're going to start to see a V recovery where the business goes up fast. And if you look at the previous recessions for that business, that's exactly what they experienced.
All right, so tell me, as a shareholder, and I've told many people in the club, this is the best stock for the long term. What do you say for people right now who are saying, you know what, I don't know. I mean, I didn't hear anything that says that next year is going to be a breakout year, 2027 maybe, but it's worth holding. I mean, what do we say?
Well, I think one of the things that we tried to get across to people today is that there's the power of the cash flow of this company that we've kind of really brought back to the last 2 years. I'm going to continue to do that next year and beyond, which allows us to get our leverage where we want it to be and eventually buy back our stock. So that's an important part of the strategy that we'll be focused on. The other thing is that, there's going to be some short-term things like tariffs to navigate.
$200 million headwind.
Which is a big headwind. But you know what? We think we have a plan that we can execute on. We've already started to talk to some of our customers about price increases. I've spent a lot of time in D.C. talking to the new administration and really making sure that we have a voice at the table around the tariff process. I completely understand what President Trump's trying to do with tariffs, but I wonder if it's really something that shouldn't be broad-based, but more specific to certain industries where Chinese products are more challenging coming into the U.S. market. That's not necessarily our case. Right. And where power tools and hand tools and those types of things, 50% of what we sell in the U.S., we make in the U.S. And 25% of what we what we sell in the U.S., we make in Mexico, and the remaining portion comes from China and Asia.
Well, it's much different from the way it used to be.
Yeah,
the
totally
reshoring has been important, and you've been working on this for a long time. Yeah. To me, I think that all of these things are momentary, and we have to think longer term. Yeah. And that's why we're going to stick with the stock.
Excellent.
Thank you so much to Don Allen, President and CEO of Stanley Black and Decker. You know their brands. You've all used them. You know how good they are. Ed Money's back in. It is time. It's time for the White Round. Chris, that's right. Round for calls. I'm the stock is started by Vice President of the College State. I'm a step really way. Play this out. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Let's start with Jeff in California. Jeff.
Hey, Jimmy Chill. Thank you so much for telling us to buy Nvidia because I bought a boatload. In fact, I've got about $235,000 worth of Nvidia and NVDL. But, Jimmy, I did a no-no. It just might become a yes, sir. I actually almost stopped diversifying about 8 months ago, and I bought a whole bunch of Nvidia, and my account is doing incredibly well. It's kind of like being a basketball owner and owning LeBron James. But let's switch gears. My stock is Lunar, LUNR, which is Intuitive Machines.
Right. Well, I'll tell you, you did switch gears. Now, that stock is up a great deal. It does not. It's kind of the polar opposite of Nvidia in that it makes no money. Matter of fact, it lose a lot of money. That said, look, I know a hot stock when I see it. I'm not going to fight the speculation for space anymore because everybody wants a piece of what Musk has for space, but he doesn't have it yet. So I'm not going to bless it, but I'm not going to fight it. Let's go to Jeff in New York. Jeff.
Hello, Mr. Cramer. This is Jeff from Sodus, New York, in the Finger Lakes region, where the Buffalo Bills are making everybody very excited up here.
I love the Bills. What can I say? They're my sister team. AFC. What's happening?
Not so exciting as how bad PepsiCo has been doing this year. 52-week low yesterday. It has a 3.5% yield, but I'm down 20% on the stock. Should I buy more?
I think Ramon LaGuardia is doing such a good job, but the odds are just right now. If you have the Fed cutting rates, you shouldn't own the stock. If you have the GOP-1s, you shouldn't own the stock. If you have people saying that junk food is not good for you, you can't own the stock. And it's just become too darn hard. So even though it's got a 3.5% yield, I do think it goes, unfortunately, I have to say it, I think it goes lower. Let's go to Jane in Texas. Jane.
Hey, Jim. Hi. So nice to hear your voice. I want you to know I'm a first-time caller, and I haven't been listening to your show all that long, but I really enjoyed and I value what you have to say. So,
thank you. Thank you, Jane.
And I really want to hear what you have to say about accidental petroleum, OXY.
I think it's okay. I think Vicky Help's done an okay job. Look, it's Warren Buffett's oil. I don't know why he anointed this one, but he's anointed it. He got a very good preferred deal. Look, Coterra is the way I like to do this thing. CTRA, and by the way, they are not climate deniers, all right? Coterra is run by Tom Jordan. The stock is really on a tear lately because people realize the last acquisition he gave, really, he brought him a lot more oil, so that the portfolio between oil and natural gas is much more balanced. It's a buy. Let's go to Michael in Alabama. Michael.
Booyah, and world time, Mr. Cramer, long-time viewer. My stock is Globe Life.
Well, it's kind of a interesting Medicare supplement insurance company. Nothing wrong. It sells at 8 times earnings. I'm going to tell you it's fine. It's not exciting. It's not boring. It's just fine. Let's go to Gentry. Gentry in North Carolina. Gentry.
Booyah, Jim, from the Tar Heel State. First-time caller. Thank you for all you're doing.
All right. Let's go to work.
I'm getting some heartburn, Jim. I invested in a company that actually is supposed to help last spring, and I can't fathom where all my earnings went after a great summer on PHAT.
Fat. Man, I'm thin on fat. I got to do some work on this one. I have fat. Anybody know fat? I mean, that's PHAT. No, I'm going to study it. I don't know it. I'd rather not cuff it. You deserve a good answer, and I'll get it for you. And that, ladies and gentlemen, conclusion of the Lightning Round. Is it time for a Marlboro Friday in retail? Now, there are probably only a few people on Earth who remember Marlboro Friday back on April 2nd of 1993. I don't even talk about cigarette stocks these days, and I certainly would never recommend them because I got scruples. But back in 1993, when I was a hedge fund manager, I was a lot less into scruples if it meant giving up on stocks with good value. I remember I was in my home office in Bucks County, Pennsylvania on that bright, beautiful spring day. I traded out of that house in a little converted garden shed. Most of the time it was incredible fun. I guess I was an early work from homer. But I wasn't a happy camper on April 2nd of 1993. That was the day that Philip Morris decided, unprovoked, to reduce the price of cigarettes by 20%, taking a huge hit to its earnings. I mean, crushing them. The stock dropped almost 30% in response, and it took down all the branded consumer packaged goods plays with it. Why did Philip Morris do such a silly thing? Because it saw the writing on the wall. Generic cigarettes were eating their lunch, and Big Mo knew that there was no loyalty to tobacco. Sure, for all I know, you could taste the difference. I don't know. I never smoked, never saw the appeal. But the people running Philip Morris didn't want their company to go the way of its competitors with their endlessly sinking stocks. It took a couple of years for Philip Morris to recover from Marlboro Friday, but it did recover much stronger than any of its competitors. Not only that, it ultimately came out on top of one of the most lucrative rolling breakups in history, selling off its Kraft subsidiary, then splitting the tobacco business into Philip Morris International, leaving the domestic business to Altria, which remains a prosperous, high-yielding company. Even though big tobacco's lost its luster in recent years, Altria still dominates the market here in the U.S. Now, I'm thinking about Marlboro Friday because I actually see a similar situation developing in retail in this country where someone just has to blink. Someone must do it. Someone other than Walmart or Costco, the bricks and mortars that already have ultra-low price. One of these competitors needs to pull off a Marlboro Friday by staking out a must-shop proposition. Maybe it should be the dollar stores, which are dollar stores only in name because most of the goods now cost $1 and change at least. Maybe it's a Kroger, maybe it's a Kohl's, or maybe, most obviously after today, it's a Target. It's simple. They don't have to mark down the whole store, but they need to roll back prices for an important good in each aisle. Roll back to 2019, maybe before pre-pandemic levels. Now, I don't care if they lose money on the transaction. Maybe it's even better that they lose money on the transaction, as long as it brings in traffic and wins back the customer loyalty. I don't know if many people from this current crop of retail execs remember Marlboro Friday. Maybe they've never even heard of it, but the lesson was clear. You want to engender loyalty? You want to be the market leader? Then you have to take a beating on price when the consumer's desperate for value. More accurately, the shareholders have to take a beating, at least in the short term. The beating belongs to the shareholders. You have to be willing to do the one thing we're all told you're never supposed to do. You have to crater your own stock. One time only, rip off the Band-Aid. Who'll do it? I don't know. But whoever slashes prices aggressively enough will be able to make a comeback from the dustbin of also retailers. Those who don't escape from the dustbin are headed right for the dumpster. Retail execs, the choice is yours. You either pull off a Marlboro Friday, or go Google it, ChatGPT it, or you become irrelevant. I like to say there's always a bull market somewhere, and I promise to try to find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.